be uploaded on YouTube channel later, so you could refer it later too. So with that, I want to kickstart the session. So good evening and hi Chandu, hi Sunita, hi Prayag. Welcome once again to the session. Hello all from the audience who are all attending it. Thanks for making time on a Friday afternoon. Um, so I want to kickstart by a quick round of introduction. We'll start with the lady first. Uh, uh, Sunita, I know you're the president of Early Stage Ventures at Let's Venture. Would you want to share a quick background about your role and anything else that you might want to share about your past experiences?
Sure. Just a quick thing. Let's Venture is an online platform for startups to raise funds. We're there across the spectrum from almost a seed to IPO, an early stage platform, which is what I head. And then we have a growth and late stage platform as well, and the SaaS product for ESOP and cap table digitization and management. Right, we've been around for almost 8 years now, right? And I head the early stage business where we look at companies raising anywhere between 100K to $1.5 million, right? Um, I've been with them, like I said, almost 7 years. And prior to that, I was also with a fund called Avishkar, which is an impact investment fund. And like a typical Bangalorean, I did my engineering and then went on to do my B school and then the finance background, right? So that's been my journey. But I think the startup ecosystem is very dear to my heart. Been 10 years in this space, so I think I look forward to this.
Fantastic. Thanks so much, Sunita. I mean, hope we'll see more and more cultural enterprises being invested by Let's Venture over a period of time. Chandu, I know you are, been around investing in early stage companies in technology, in consumer for quite some time. Would you want to share with us a quick journey and what you've seen over your career in terms of the change in the startup landscape?
Okay, so one is I've been on the other side. I was an entrepreneur myself for several years at a time when it wasn't fashionable to be an entrepreneur, and at a time when there was no such thing called a VC or a private equity, or forget about an angel investor itself. So, in fact, I got my first, I would say, angel investment probably in 1999. And thereafter, we managed to get institutional funding in 2002. And we managed to give our institutional funders about 8x in about 3.5 years, which then realized, that the moment you make money for others, others get to know you. So, and then you become sought after a little bit in one sense. After that, I sold my company in 2011, September, roughly about 10 years before.
Which company is this, Chandu?
This is a knowledge process outsourcing company, one of the pioneering outfits, and it was called Scope E-Knowledge Center. And that time it was relatively a people-driven business, though the early stages in 2005-6, we started doing things like pattern recognition algorithm, etc., which today is more popularly known as AI/ML.
Yes.
So we could have repositioned it and made more moolah out of it probably today. So then from 2011 onwards, 2010-11 onwards, I've been investing in startups and also been part of the startup ecosystem. I divide my role into three parts, what I call startup, scale up, sell buy. In startup, I invest individually, plus I am on the board of a couple of incubators. That's one. Number two, I'm also in scale up, it is like growth funding. I'm on the board of advisors of a Chennai-based pharma and healthcare fund called Fulcrum. We have invested, for example, in things like Manna, which is a native ethnic food brand, out of Chennai. It's doing quite well. And Specs Makers, a retail chain of, say, spectacles and opticals, so you can call that, it's an organized India brand of spectacles and all that. And I'm also on the board of Mentera, which is a social impact fund, which is Sunita's past life. And in sell, the third space, which I call it sell buy, I am part of a investment bank out of New York called Chesapeake Group, and we do tech-based M&A cross-border in the $10 to $100 million space. So I'm kind of straddling the entrepreneur ecosystem from the embryonic to the exit.
Wow,
So
that's
this is
quite
in brief.
that's a big spectrum of activities that you're involved in.
Yeah. So I thought it was difficult for me to be an entrepreneur and, and getting funding and all that. So I thought the best way is to kind of stay in it and try and help others through my mistakes,
Fantastic. Thanks. Prayag, I know you come from an investment banking background. You've been with SBI Capital Markets. Very interesting that from public markets, you moved into private markets. Now you're with Fireside Ventures. So were you bitten by the startup bug? Or you thought there's a scope for making a lot more alpha on private markets than the public?
Yeah. So yeah, I mean, I started my career in investment banking. It was about 10 to 12 years back. But the idea was always to get to the buy side, And of course, so before Fireside, I worked with a fund in Bombay called Ivy Cap Ventures. So I was there for almost 7 years, and that was slightly different. We were investing more in consumer tech, enterprise tech, but that's where I had done a lot of investments in different kind of brands like one of the larger ones would be purple.com. Then we had done a significant check also in Clovia. We had invested in Biryani by Kilo, Bluestone. So that's where I got exposed to the entire D2C brand ecosystem and took a liking to it, which is and then the natural transition from there was to move to a brand like Fireside, which specializes in that. Just to give a quick brief on Fireside, at Fireside, we invest only in consumer brands. Uh, Broadly in two buckets. One is FMCG, second bucket would be non-FMCG. Within FMCG, the two large focus areas for us are F&B and personal care. And non-FMCG, of course, there are various segments we look at like fashion, lifestyle, apparels, now getting into consumer electronics and, a few more areas. Again, right now, from a fund perspective, we are deploying a second fund, which is about a 120 mil fund. Around 10 deals already in. We'll probably do another 6-7 deals over the next 1 year from this current fund. The first fund was fully deployed. It was a smaller fund, 50 million fund. Again, some of the brands you may be familiar with, like brands like Mamaearth, Boat, and we were the first institutional check in all of these brands.
Right.
And then in the food space, we had a few brands around Yoga Bar, Badam Teas, Kapiva. Personal care beyond Mamaearth, we had Bombay Shaving Company. We have another brand called the Ayurveda Experience targeting the US market. Again, in the non-FMCG bucket, beyond boat, we have a bikes brand, a large, which is called Alpha Vector 91 bikes. And also that's broadly the areas, where we have three buckets, I would say, where we are typically investing in. So yeah, and in terms of check sizes, on an average, we look to do about a 5 to 6 mil check over a period of time. Typically, we start off at a pre-series where we put in about a couple of $1 million, 1 to 2 million, and then we keep topping up across the rounds. So
right.
That's a quick brief on Fireside.
Fabulous. No, thanks. That's so useful. I mean, that lets me to the next question in terms of, if you look at our audience and community at NICE, you have about 50% of them existing sort of entrepreneurs in the culture space. The rest all are thinking about entrepreneurship, right. So what should a founder, a typical cultural entrepreneur, when you think is ready to raise external funding? We can talk from a VC perspective, or from, when should they go approach Let's Venture, for example, Sunita, and when should they approach somebody like you, Chandu? Yeah.
Sure.
Startups, yeah, please.
I think it depends also a lot on the space you are playing in. Like even as VCs, opportunistically, we do look at doing seed checks in segments, spaces which we have identified are interesting to us. And if we get a strong founder with a proven track record, we are happy to take even early stage bets. Like in a couple of deals, like one of the companies is a company called Gynoveda, where we actually went in pre-revenue, put in $1 million, and that business has done really well for us because we were very focused on the entire that femtech kind of a space. And once we got a strong entrepreneur in a particular segment, we can always also go out and take an early stage bet. But typically from a founder's journey, if you were to look at it, like, at a very early stage, they would generally what we see is, the initial round, let's say the first couple of crores is raised from friends and family. Then the next step is, when they're raising up to about $1 million is typically when, they're going out to the seed funds or the angel community and all to raise that capital. And more often than not, the institutional investors typically comes in at a pre-Series A stage. And then, of course, there are VC funds who will come in at a Series A, Series B. Then there are, you get into the entire growth capital phase, where Series C onwards, you have the growth capital, mid-market PE funds come in, and eventually the journey moves to the larger buyout kind of funds, or it could even move to an IPO. So it depends a lot, but that's the typical journey for a startup entrepreneur. I think when you raise capital, that's an interesting question. I think, again, from a investor's perspective, institutional investors typically would want to see some kind of a proof of concept, like the product is in place, there's some initial customer validation. At least that's where we come in. We look for some kind of, product validation, customer validation, proof of concept, product market fit being there, and you are raising capital for basically scaling it up. But I think again, the perspective would be slightly different for an angel investor, maybe, or for a seed stage fund. Maybe I think Chandu or Sunita.
No, so, Sunita, this is always a debate in an entrepreneur's mind, right? Should I raise? Because today, it's almost a badge of honor, right? To raise capital from a VC, or angel, or whoever, right? Like a third-party source. So, be it may the pros and cons of it. When you think that you're building a new market, when do you think they should come and approach somebody like a Let's Venture? What's been your experience?
I think just to one point which you actually mentioned, Vidya, I think, like I said, it is being treated like a badge of honor. And unfortunately, that's how the market is looking at it, right? But as a founder, the point is, not because somebody else raised funds is why you should raise funds, right? There has to be a rationale why you're looking at raising funds. And, as much as an oxymoron it can actually sound, it's not necessary that every company actually goes ahead and raises funds, right? Everybody has their own rationale of why they're building a company and what they actually want to achieve at the end of the day, right? And like Prag actually mentioned, in India, actually still we are not such an ecosystem where we're ready to take as much risk at an idea stage, unless you've been a serial entrepreneur or somebody who's actually shown enough of an expertise or experience in your previous journey. People don't invest at an idea stage, right? So people want to see that POC actually coming into play. PMF, yes, maybe product market fit can come in when the Series A or the VCs actually come in, but at least the product has to be there. And each company actually has its own cycle, right? Because if it's a completely disruptive market, people won't be bothered about numbers because they know that it's something which is completely different. I'm okay to kind of venture out in the early stages itself without traction. But if it's a market where you know that there are other players, there has been enough traction being shown by the other companies, then people want to look at what is that competitive edge that you have, right? And are you doing things differently? And that's when investors actually come into play, right? So it depends on each kind of business, and I think each of them will be evaluated accordingly. But idea stage, very frankly, I think the handful of companies is what we have seen in the ecosystem that end up getting funds.
So in some ways, even if it's not idea stage, but I have typically the way we define cultural enterprise at NICE, Sunita, is you should be making some revenue. We may not be making profit, but you're making some revenue, right? So earlier this year, when we did the business plan competition, that's how we defined companies that are making 50 lakhs and lesser, or companies that are making 50 lakhs and more, right? So we know entrepreneurs who already do the product market fit, unlike typical technology company, you're making products, right? So, when should they think about coming to a Let's Venture, right? What should be their sort of, drive? So say, for example, should they raise money from friends and families like Prayag mentioned, or at what stage do you think they should come to somebody like Let's Venture?
So if people already have early revenues, I think it's definitely a time to come in, right? Because you also look at different quantum of investment. Today, market numbers for a seed investment itself has dramatically changed. What used to be a 200 or a 500 case today, $1 million, $1.5 million for early stage companies itself, right? And in the span of a year, very frankly, if you look at how markets have been changing. But, if you're very early, like you said, hey, what your total revenue is less than a 50 lakh, you will then look at anywhere between a couple of crores to 3 crores is kind of the number which you will look at to be able to raise, right? So you'll still raise it with a smaller quantum of fundraise. The moment you know that your numbers are much stronger and your percentage growth per month, right? It's not even just about absolute numbers. It's about your growth rate as well. That's when you're able to raise a larger quantum of investment. So on the platform, you'll actually see across the spectrum. We've done as low as 100K of a check size into a company when it's really early, to $1 million, $1.5 million as well in the company's life.
Okay, thanks. That's really useful. Chandu, you've been around and seen a lot of companies. You've been on the other side. Now, as an investor, what has changed? What do you think today is the role of an angel investor such as yourself, right? What should when should a founder approach you or people who are in the angel investing space? What do they get out of it? I mean, on one hand, you have so many people, so many platforms, but individuals been there, done that. I think that's very unique experience one can't get, right? So along with capital, what do you think an angel brings on board?
Okay, this is a phrase I like to use. It's called smart money. Basically, it means along with the money, you bring in other things, hopefully. Now, of course, like I always say, that angel is a 5-letter word, but angel is the other side of what I call is another 5-letter word, which is devil, which is essentially that you should also be prepared for the dark side of the other side of the coin. That along with money comes concern, but concern can also turn into irritation and extra overeager involvement. So I think what is important for you at that point is to understand the chemistry that you have with those potential investors. It is very vital for you to get that established. And for that, I think one of the things I am finding actually is while the ecosystem is evolved, I would reckon even Prayag would agree and Sunita would agree that barely 1% of the decks that we see actually get funded. And that's the sad part, So that means that 99+% of the entrepreneurs aren't yet funding ready from even a pitch deck point of view. Okay, many times they don't speak that language that seems to resonate in the startup world. For example, you may have a fantastic idea or a product, but it should resonate with the mind of the investor. So for example, which KPIs demonstrate success? Like Sunita talked about month-on-month growth. In SaaS businesses, they expect month-on-month growth of 15 to 25% or more with a churn rate of XYZ percentage or less. So can you show that kind of metrics and show that you understand what it takes? Can you show ways by which you can minimize the risk of investors? Investors finally look for two things when it comes to money. One is return of capital, two is return on capital. So many times people take the money and then forget that they have a responsibility to return that money in some way or inform the investor. So I think what is important for the entrepreneur is for him or her to first understand that mindset, and that the mindset is of a different kind of a beast. And am I that different kind of a beast? Am I ready to change myself in some way to be this new startup entrepreneur? Most times, I find the entrepreneur is not yet ready. And I think what is essential, therefore, I feel, with the growth of the incubator and accelerator ecosystem, is for many of them to try and get into such into the ecosystem by getting their toes wet through the incubator accelerator mechanism, rather than directly going. Many of us are actually going to these watering holes to find potential investee companies, and that would be a good place for them to test and validate a lot of their assumptions.
Fantastic. No, that's really, really useful. But truly, when it comes to talking about the mindset and being ready, in the context of cultural entrepreneurship and cultural enterprises, right, as opposed to a typical technology company, right, we find there is it's still an evolving sector, right? Now, how does somebody convince an investor who's already sort of investing in the technology space, looking at SaaS, which is growing 15-20%, as opposed to saying that we're investing in these vegan bags, that we're catering to the Indian consumer or overseas, or we're building this very cool Ayurvedic beauty product? How should they sort of prepare themselves when they're pitching to a VC or an angel or a platform like Let's Venture? Chandu,
I'll just start with that. See, if you take honey, for example, the largest producer of honey today is the KVIC, Khadi Village Industries Corporation or Commission. Now, I mean, if you come and tell me you're going to make honey and you're going to get it from the apiary and all that, it's just another business as usual. But suppose you're like I mentioned, I have an investment in a company called Indus Valley, which makes healthy cookware from natural materials like cast iron. If you tell me you're going to be a direct to consumer company and you're going to only be online and you're not selling offline, and you know which kind of target segments you have in mind, which cities you're going to target almost to the pin code level, how you're going to sell it digitally online, you know your cost of customer acquisition versus a potential lifetime value or an order value, you know your product development map, you know how you're going to source your products, then I understand, hey, you know, this guy is not just talking about selling cookware or making and selling cookware, but he and she, I mean, it's a husband-wife duo. So they both understand what it takes to scale up an enterprise. So I would say this is the mindset change that you kind of have to think about. It's not just about saying, I can create great honey and sell great honey, but I also know how to do all of this in a scalable manner. I can use technology at the right places in the right way. I can do it in an asset-light manner. The kind of language that you use, the kind of model that you might use is quite different than the business as usual model.
Okay, fabulous.
Maybe I can just add to that. So we have a few investments in some of these segments. Like under Ayurveda, we have a food brand and a personal care brand. We have a food brand called Kapiva, which is pretty large. I mean, again, the way I think what is critical here is what does the brand stand for? I think that's very important to understand what is the key consumer insight or the pain point with what you are solving for. That in a way defines the kind of brand architecture which you are building out. And akin to that, you know, it's almost like a triangle would be what is your product strategy, because it's very important. A lot of times we see the product strategy for brands actually not being in sync with the overall brand thought. So I think that's another. And the third part is the pricing strategy. Are you a premium brand? Are you a prestige brand? Are you a masstige brand? And all of this eventually, you know, flows from the overall brand architecture which you have built. And in a lot of cases, when we have invested, to be honest, the founders may not have had complete clarity in terms of what is the kind of brand thought or architecture they're going to build. But at least from our perspective, it was important as investors in consumer brands that we had that clarity and that we aligned with the founders. This is the way we are thinking about it. I mean, do you agree or disagree? You know, so, I mean, I think it was very important to get that alignment in early. Similarly, like I said, in Ayurveda, we have another brand called the Ayurveda Experience, which is primarily taking Indian Ayurveda to the world. They primarily sell mostly in the US markets. Again, both of these brands are north of 100 crores right now. But I mean, D2C brands. Also, D2C doesn't, just because a brand is D2C doesn't mean that they will not be omni-channel. Every brand in our portfolio at some time in the journey goes omni-channel. It's just the number which differs. Let's say a larger brand like may go a bit later at about 300 crores. A smaller brand may go a bit earlier at about 50 crores. So or a different, depending on the category. A personal care brand can afford to probably stay digital online first for about for a larger till about a larger scale. So I think D2C and also D2C, there are, I mean, again, online, there are two parts to it. One is your own website. Second part is your marketplaces. So, I mean, just because you're a D2C, there are some D2C brands which, you know, would be not so large on their own website, but a significant part of the orders may be coming in from the marketplaces. So I think there's a bit of misnomer in the market when people say D2C, they mean that, you know, the brand should be selling only on their own platform and majority of the sale should be coming through that channel. So, but what we call as D2C is more like, you know, the brand starts off first as digital first or digital native, which inherently means that their own website or the marketplace is the large channel for them. And eventually everything goes omni-channel. So, you know, I think, and right now you are having a lot of convergence also happening between offline and online, you know, like there is a big trade which goes from offline to online. There is, of course, COVID. Because of COVID, a lot of businesses have pivoted the GTM to more online. But eventually, I think the convergence is happening now with Geo coming in and various other channels, right? So I think that's something, you know, the GTM is definitely evolving, you know, as we speak.
Fantastic. No, it's good insight. Sunita, so, hearing, both Prayag and Chandu talk about the value proposition and how should they go about GTM. PM. What's your sort of experience and take on brand-led investments, particularly with D2C brands gaining a lot of traction? Suddenly, a lot more people in my mind, I think, would be interested in building brands than purely technology startups, right? That's what we see, right? What's your sort of take on it? How should they go about evaluating it, or how do they go about deciding how much money they should raise? Because that, I think, is a very critical question, right?
And I think just to kind of add on a couple of points where Chandu and Prayag actually spoke, right? Just from first, in terms of even positioning, I think storytelling is one of the most important things, right? It's not about being a tech entrepreneur or a non-tech entrepreneur. It is about building that story and talking about the story the right way and connecting with the investor at the same time on that story, right? And that becomes the most important part. And most of the companies who've been able to raise a large quantum is actually on storytelling and not just on numbers, right? And especially at an early stage, it is all about the founder and the story which you're actually building behind it. Right. And over the course of actually, while angel investing predominantly started off from a tech perspective, I think in the last 2-3 years, we are seeing a lot more investors actually looking at non-tech D2C investments. In today's paper, if you actually saw, there was a note which basically said every once in 2 weeks, there was a D2C brand which actually got funded, right? Which means there is a lot more interest which is there. But still, I think one very, very important thing from a founder aspect is to be able to identify those investors. Everybody will not do a D2C investment, right? So you can't just bombard and say, okay, let me kind of just go behind everybody. You know that there are people who are looking at it, and you know that there are specific funds like Fireside and Sauce and all which have come up, which aren't looking at specific spaces. So you need to do your homework as a founder to look at who should I approach, right? And not just talk to anybody, because if I'm a purely tech investor, I will slash down the company and say, hey, I don't think this makes sense, right? From a business perspective. So approaching the right investor becomes very important.
Should cultural entrepreneurs pitch to Let's Venture too for their venture? They have a consumer brand. Can they come to you guys too?
Yeah. So we've done actually quite a few these companies, like he was talking of Fireway. The experience was actually one of the earlier investments post which Fireside actually came into play. Indus Valley was also another company which raised, and we've had, Caffeine, which was a D2C brand. Again, from a cultural aspect, we had a company called Lalten, which is basically looking at, they started off from an Indian fabric concept and clothes for the international market, and then kind of expanded into other sustainable products as well, right? And a very interesting company actually, when we say cultural and, very culturally, we eat pan and bida. So there is a company called Beetle Leaf, which makes it makes very interesting versions of the normal bida which we get. And it's a very interesting way of how he's been able to sell it to people who otherwise would not have had it, right? And it's a very cultural thing from that aspect of our own, food habit.
Absolutely, yes.
So, you're able to, and it's about, again, how you're positioning it, right? He didn't position it as a regular bida company, which I'm selling online. Like Chandu said, hey, what, am I offline and I'm just, going online and actually selling it? It's not what it is. He created different versions, which is going to be accepted for different palettes, right? So it's your story for that larger market base, which you're actually capturing. And that's how we will actually position it, right? So when the companies actually start for fundraising, it's not that they had, multiple crores of business. It's about being able to position, right? It's about the story which you're actually building for the longer term, right? And like Prayag mentioned, is how is that from a brand building perspective you're actually looking at, right? And I think brand positioning comes a little later when you're able to kind of establish that there are enough people who are ready to buy this, and if there is that, virality in terms of being able to buy that product as well, right? But in an early stage, it's about the story. It's about what your vision for building that brand is. And are you able to kind of showcase your product, be it tech, be it non-tech, it doesn't matter. It's about how your positioning is and the right kind of people you're targeting. So I think that's where it will come down to, right? Than anything else. All of these companies actually raised at very, very early stages on the platform. They were not doing crores of revenue at all, right? They were doing early investments, but people look at, like Priyam mentioned, is it online? Is it offline? So which means what is your customer acquisition cost? What do your unit economics look like, right? When you scale, how much money are you going to spend on your branding, on your marketing? How do your numbers actually stack up against those, right? That is where people actually start looking at from your projection aspect to see your vision. But end of day, bottom line still comes down to the founder and storyline from what I can see.
So how should they think about how much money they should raise and how much should they dilute? What's your experience been?
So in an early stage, see, any time you raise, at any stage you raise, right? Normally you as an entrepreneur should raise for at least a 12-month timeline, right? Minimum. Because you know when you raise money, you want to be able to use that money to showcase some kind of an execution and thereon actually go and build your next round from there on, right?
Right.
If you raise too less, then you know that you're actually stuck. You can't show execution. You're out in the market again in 3 months timeline and nobody's going to give you a better number thereafter. So a 12-month timeline at least gives you a 6 to 8 month heads up in terms of your execution for you to go ahead and raise your next round thereafter. So what does it take for you to actually build a 12 to 15-month timeline? Right. And a very interesting way in terms of how people also look at it, right? Two ways. One is to say, hey, you know what, I'm ready to dilute X percentage. So in an early stage, you know you're anywhere diluting between say 10 to 15, 20% based on the quantum which you're raising and the stage you're in. The other is, hey, you know what, I know I'm building this. I want to go to Fireside in my next round. Fireside looks at these kind of metrics, right? If I need to hit those metrics, what do I need to actually do, right? And how much money do I need to spend to get those metrics? So people also look at that. It's important for you to know, especially if you're thinking of future rounds of investments, you need to think of that as well and work backwards to actually say, okay, this is how much I think I should actually be able to raise, as well as build on my revenues to hit those numbers, which Prayag will look at and then kind of say, hey, I think this is good on numbers for me to be looking at.
Chandu, you've seen this whole funding entrepreneurship game for quite some time. What do you think has changed? You think entrepreneurs should get stuck in this? It seems a little terrifying to plan for so many things. Otherwise you're constantly raising capital, right? But you also have a business to build. What's your sort of sage advice? What have you observed? What do you think is the best way to go about doing it?
One is, one part of it is to try and distribute that load. So if you get a smart investor on board who's helpful, that investor will kind of give you the connections. And like what Sunita mentioned, quite a few of our investments, investee companies have had the benefit of the collective network strength of things like Let's Venture. And I think Prayag was earlier with Ivy Cap, where one of our investee companies, Purple, Ivy Cap was also invested in Purple, and which was our investee company. So one of the things is an angel network or an angel investor brings you those connections, not just cash. Most entrepreneurs, I think, get stuck with these two asks, the two C's, the cash and customers. But if they were to look beyond that and they see that the investor or the mentor network can actually provide a lot more value, they will see that that's an easy way for the stepping stone for them to get access to other funds. For example, a network like Chennai Angels also has institutional funds as part of its members. So that's a good way for them to get access. We now have built a lot of partnerships with several funds, with several other crowdfunding platforms. So that again helps the entrepreneur. So many times you can distribute the workload, and this is what we actually do in many cases. So what happens then is they get the benefit of expertise from existing investment bankers, from funds, and from other investors in the same field. Just to take the thing of Indus Valley, when initial stages, you do only performance marketing. It is very difficult for you to build a brand. You don't have the money to build a brand. You can only do performance marketing to see that you improve your sales metrics. So what you tell yourself is, look, I have 3 years or 2.5 years or 3 years for me to first show those metrics to reach that life, to reach those milestones. So what are those milestones that I need to hit in order for, say, a DSG or a live Fireside or so to be interested? So before that, let me tell the entrepreneurs one very important thing. There's a very big difference between what I call a good enterprise and what I call an investable enterprise. Okay. And there's a big difference, because there may be a fantastically good entrepreneur running a very good cash generating enterprise, but it may not be an investable enterprise because I may not see visibility into the next round of financing. As an angel or as Let's Venture, who's wanting to support angels and investors, we are looking to get out maybe in 3 to 5 years time, hopefully. So what is the path to exitability is also very important for the early stage investor. And what will make other investors come onto the gravy train, so to speak. So those are critical things that we consider. And I will go back to the travel related parallel in order for you to estimate your funds. Whenever you're going on an overseas tour, estimate the number of clothes you need and the amount of cash. You halve the first and double the second. Okay. So similarly, with respect to the money you need, many times you'll find that you need X amount of money, but always keep a buffer for unforeseen circumstances. COVID being a very rude reminder of the vagaries of of business. You add a lot more, and you say, look, I need 50 to 75% more to take care of these vagaries. And I think if you look at what milestones you need to hit to achieve next round of funding, what resources you need to achieve those milestones, and what time period it might take for you to achieve those milestones, it will give you a pretty decent fix on the amount of money you need.
No, wonderful. So, in terms of valuation now, for good or bad, the technology startups world and the news that we keep hearing about unicorns and all these multi-billion-dollar exits, that has sort of, in a way, you're influencing, how people are thinking about startups and how much capital to raise. What do you think is some of the things that people should keep in mind, whether they're doing consumer brands or otherwise? How should they evaluate the enterprise when they go and approach an investor? Chandu.
Me to start?
Yeah, please.
Okay, so what I'm finding now seems to be a very standard way it is happening is I want to raise X amount of money.
Yeah.
And I'm willing to dilute between this range to this range. Therefore, X divided by 0.1.15 should be my valuation. Okay. This seems to be now some default kind of a number that people seem to come up with. And I'm finding this extremely bizarre at times. But as an investor or as an angel investor, you also have to be very careful. Many times you should not also be very greedy and take too much of a stake in the early stage, because if you're going for institutional funding, institutional funds don't like it if the entrepreneur does not have a majority. Okay, at a Series A level, if somebody a fund is coming in, most times they're very unhappy if if the entrepreneurs don't have more than 50%. So if you are greedy and you do an initial round and then you do a couple of bridge rounds, you may dilute the entrepreneur too much. So this valuation sometimes can come back to bite you as an investor. So you have to be very careful. And there are multiple today routes to valuation. I mean, of course, the Startup India and all the government things would like to use the DCF method. But for most of these startups that we invested in, that is an exercise in just, la la land. It doesn't go anywhere. So you have to use things like comparables. What do other companies in the similar space or similar types of deals, what did they get is one way. So the other one is the default way that I mentioned. Then in some cases, some people try and use more complicated ways also, but I would not recommend all that. Finally, I believe you use this, how much do you want to raise? How much can you dilute? And does it make sense to the investor? Two is, what do comparables look at? And what are comparables looking at? Like, for example, today you take SaaS, software as a service. Any company and his uncle, wants to raise money at 8 to 12 times revenue, irrespective of whether he's got a great product or not. Today, quite a few consumer companies are asking for multiple times revenue. And, it only matters to me after you hit a certain amount of basic minimum number of revenue. But they ask for multiple times revenue. Traditional businesses find it difficult to even get 0.7 to 1x of revenue. So it's very challenging. Therefore, it depends on the sector. It depends on which stage of the hype cycle it is in. It depends on the number of investors and their fear of missing out. And it depends on the track record of the entrepreneur. I'm sure Prayag will have more to say.
Sure. Yeah, I agree with whatever Chandu said just now. I think, so typically, I mean, again, just to set the perspective, we typically come in when the brand is doing on an average at least 30-40 lakhs per month at the lower end to all the way up to about 1 crore or maybe a bit higher than that, on a monthly basis. Like Chandu said, I think what we use is basically comparable, because obviously we are investing. I mean, there's an investment community and everybody is valuing in a certain way. And right now it would be a multiple of the revenues, because at the stage we come in, obviously there are no profits, there's no EBITDA, to really look at. But of course, there are some other, but that multiple depends on a lot of other factors also. One is, of course, the as investors, what we are betting on is, at first, is the founder, because the founder has to be really good and be able to manage even through tough times. Second is, of course, the space, how attractive is the opportunity and all. And then, of course, the business and what kind of gross margins they have. So a lot of factors actually go into defining what kind of multiple you eventually end up giving a business. Again, DCF, like I said, I think it's something which is primarily used by the valuation agencies to justify the valuation once it's agreed upon, to be honest. I don't think any investors are doing DCF at this stage of the business. In terms of, I think in terms of how much you raise, like I said, it should be what you need, right? Maybe like a bit more than, maybe keep a little bit of a buffer, because what you're going to get judged on when you go to raise your next round is the kind of capital efficiency you had on your earlier fundraise. At what stage did you raise your current round? And with that funding which you raised, what were you able to achieve? What were the milestones you were targeting to hit? And what did you actually achieve? That will define your, next round of fundraise. So if you raise too much capital and you are not able to justify that at the next round, that will in a way come back to bite you, so I think it's important that you raise adequate, not less than what you need, maybe a little bit of a buffer, but you're able to show performance on, on whatever money you have raised, that, you're able to utilize in a certain manner and get to a certain stage, which is in a way comes back, in case of a brand, it comes back to the capital efficiency. Like at every stage, we have some metrics in mind in terms of what kind of capital efficiencies typically brands are doing across different buckets with a certain amount of fundraise. So I think, that's typically the way, we look at it. I think, again, you mentioned about consumer tech. Of course, a lot of funding has got raised, there, and there's a lot of liquidity in the system right now. But I think eventually, at least when we are investing in businesses, we obviously want the business to scale fast, and in certain cases they do blitz scale. But we also want to build businesses which are inherently sustainable, which have good unit economics, which even if liquidity wasn't available on the tap like it is right now, they would still be able to sustain and grow. I think that's what we are looking at investing in. It's, for us, it's not scale at any cost. It's sustainable scale is what we are looking at.
All right. Sunita, final thoughts on how entrepreneurs, founders should be evaluating and diluting, and the capital they should be thinking about raising when they come to you.
I think Chandu gave the metric which people look at. Very frankly, that's the way it ends up happening at the early stage, right? People who do have, and I think I'll be very frank, like he said, I think one part is the investors not taking up a larger chunk, and that's very, very important from the investor side as well as the founder side. I think founders also should be cognizant that I'm not actually giving up too much of my company. But the other part is not to run behind valuations, right? Like I said, hey, there is a tech company getting this kind of number, or somebody else. It's not just about that, because end of day, you will see enough stories which have actually companies that have become really big who did not start off with great valuations in the beginning, right? Today, market has changed, valuation numbers are changing, but that doesn't mean that, because you got, I know I got a 15 or a 20 crore valuation in the beginning, but YC is giving $10 million for an early stage company, does not mean the same, right? So it's okay, because if you're able to build a business which is actually valuable, the next round is actually going to give you a much higher valuation. So it's not about running behind a valuation number, right? And I think combining both what Chandu and Prag mentioned, it's about you raising sufficient quantum for your company to be able to build the business. And especially in this space, to be able to make sure that, I am actually going to run out of money and I can't sustain myself, is a question mark which people will actually look at in this space, right? While yes, you might scale down your operations and say, okay, I might not be able to do the same number, is very different than saying I'm going to shut shop, right? That's how people actually want to see attitude from the founders as well.
Awesome. Yeah. So last one quick question from all of you before I open up for Q&A. Sunita, starting with you. So what should a cultural entrepreneur be, what do you look for in a cultural entrepreneur, when they come and pitch to you? Just a brief.
I wouldn't look at anything different than what I would look at in a normal entrepreneur, right? I will not want to categorize and say this is a cultural entrepreneur, an impact entrepreneur, or a normal entrepreneur, because everybody is still an entrepreneur. End of day, like I said, it is about the founder. Majority of the early stage investment is about the founder and the passion they actually bring to the table, the experience that they can actually bring in, right? So sometimes what happens, I might not be from this space. So how much do I know about the space that I'm actually going to be building on top of this, right? But thereon, yes, it is going to be about what is the kind of differentiation, or what is it that I'm actually creating as a product. Is it just another product in the market, or is it something which is slightly more differentiated? Not in terms of pricing models, because that's the worst way of actually differentiating yourself ever. But what are the other things which you can actually come up in terms of USPs of your own product is what anybody will look at, right? And I think that's the key thing. It is not about what kind of company it is. Its bottom line will remain the same at the early stage
Understood.
investment.
Fantastic. Chandu, your quick answer for what do you look for?
I know whether it is like, I think Sunita hit the nail on the head by saying it really the criteria doesn't change whether it's social impact or cultural or technology or consumer. But I would say that if I were to look at it from, because you have a lot of people from that background, one of the things I saw in the social impact spaces, many of them bring the NGO mindset to the entrepreneur space.
Right.
So I'm saying be wary of bringing a pre-established fixed mindset. This is how like honey should be sold the way KVIC sells it. That's the most pristine way of doing it. I think those kind of what I would call irrational stupidities should be thrown out of the window and come with a fresh mindset saying, I'm here and there's nothing wrong with making money while doing something. You say, for example, there was a fellow I remember who came like online prasad, getting prasad from multiple temples across the place. There are people doing online upakarmas and pujas. Now the purist might say, how dare you do this, etc. But if you say that I can blend technology, I can blend my ability to go to market, I can make a large number of people access this. One of the things I feel sad about is that the number one meditation spirituality app in the world is Headspace, and it has not come from India. It's doing $100 million of revenue. It's got funded over 218 million. But why has it not come from an Indian entrepreneur? You feel a little sad. What does it take for us in India to build such an app which can go global? And we have the content, we have the heritage, we have the experience, we have the lived experience. What is the mindset and the technology?
You're reinstating our purpose and reason for existence. That's right. Yeah. Nice exits to support and create more.
And they've been backed. I think like people like Soul Tour have been backed by Lightspeed Ventures.
Yeah.
And people like Headspace have been backed by a variety of venture capital funds. So it's not lack of funding. I would say it's a lack of imagination and an ability to build a cogent business model that is holding back a lot of these, what you're calling cultural enterprises or entrepreneurs.
Chandu, with this thing, I will also say it's also about the investor mindset to a large extent, right? Sometimes it has to be a fad in a different country for us to be looking at investment into a company in our own country. I think it's also about a lot of investor mindset changes which need to happen too, because I shouldn't be looking at, hey, what worked in China or what worked in US for it to work in India, right? Even, I think we were talking yesterday with Vidya in terms of saying even yoga. I think while there were yoga centers, I don't think unless it became so hot in the US, people started thinking of yoga a lot more in India, right?
Exactly,
because the Western world is talking about it. You needed validation from a different market, which shouldn't be the case.
Yeah, that's a valid point. No question. Yeah. It's definitely a valid point. But I think, like, for example, I told you about manna, which is an ethnic food mix.
Yeah.
I mean, more than 100 crores plus. I mean, so there are opportunities, and we are seeing such great niches in the Indian marketplace. So I think it is useful for the entrepreneur to not have a prefix mindset. That's basically my point, and come with a fresh mindset, fresh and open, what I would say, mind in terms of exploring ways by which you can exploit these markets.
Awesome. We have no questions from the audience. I think first question is to you, Prayag, from Vinay. For a D2C startup in the food space like Slurp Farm or ID Foods, what are the most important milestones you need to meet to raise early stage funding? Right?
Sure. So I think in terms of, when you're looking at food startups, I think, of course, the first thing you look at is in what category they are playing. Is there a large opportunity or a gap or a consumer pain point which they have identified, which they are going after? The two most important things, at least in our mind, is always the space which you're going after. Is it large enough to build a scalable business? Second would always be the team. Because that's the bet you take in that sense. Apart from that, I think beyond these points, there are other factors typically you would look at, which would, entail in terms of the landscape, which are the other players out there, where are they stacking up against them, the business model, the kind of economics, margins the business has. And of course, then, you get into other areas in terms of like for a D2C brand, it also becomes important at an early stage. What's the kind of offline online mix you have? How much, I think that's, and then of course, supply chain and also the various other factors come in. But the two big things is always, what is the consumer insight or the value prop which you're offering, and how are you doing it differently? What's the key differentiation out there in terms of whether it's a product differentiation or, what is the key differentiation out there? And of course, what is the team, which you have in place?
Awesome. Thanks. Anything that you would like to add, Sunita, Chandu, to this? We got a couple of more questions and then we'll wind up.
No, I think Prayag has answered it cogently.
Yeah.
Awesome. So another question is from Yogesh Patel. What would be the right time to raise capital? We are bootstrapped and have developed unique product. How to find an investor who can back us up?
I have this. I use this phrase. That is this proverb. When when opportunity knocks at the door, you have to be there. Okay. So what happens today is that most fellows are sitting inside the bedroom with the AC on, with their headsets in their ear, and the opportunity will be knocking at the door, and they're nowhere close to it. So I think the first step is to go out into the watering holes. Where do you find these investors?
Yeah.
Do your homework a little bit. Get plugged into entrepreneur associations, like for example, in Bangalore, TIE or NICE or whatever on the one side. Go into incubators. Be there where potential investors are and understand more about them. Speak to other entrepreneurs who have got funded. They are a great source of information. Today online, there's so much of data available, on various things. There are also now databases like Traction or Vinos, which has details on investments by investor and which sectors they've invested in their past investments. I think there is a little bit of work that people need to do. Right now, the situation for quite a few entrepreneurs is that they want to be like what we call in Tamil Nadu, pesnified tair sadam. Basically, it means somebody takes the rice, somebody takes the curd, somebody mixes up in a bowl for you and then says, open your mouth, I think that's a bit much. I think there's a little more work that you do. You'll find there's a ton of things you can do out there.
Okay. Very native example. Thanks so much. So we got one more question from Usha Bora. Usha, by the way, folks, is a very exciting entrepreneur. Has launched a brand called Germany out of Paris in the crafts and the weaving and the textile fashion space. Her question is, coming back to valuation and benchmarking against other companies, how do cultural enterprise, they are as a segment, they're new and they're in the initial stage of businesses. How do you find benchmarking? How do we sort of identify what's the right valuation for me? Because I'm not Flipkart, I'm not an Amazon, I might be selling on them. How do I go about valuating my business? I'm not a SaaS, right, which has got like 20 plus percent of EBITDA coming in or growing at 50% growth rate. How do I sort of benchmark and identify my valuation? So it's a valid question.
Yeah, I mean, typically you will look at some kind of proxies will always be available, like in the sense that it may not be in the exact same category, but if you can find a similar business in the brand space, which is, got a similar kind of a margin profile with a similar kind of a repeat profile. There's a reason there's a delta between the multiples an FMCG brand gets and a non-FMCG gets, because FMCG is very highly repeatable. I mean, in your tech terms, maybe FMCG is something like, SaaS, which is recurring revenues, unlike non-FMCG, which is not recurring in that nature. So typically, you would try and bucket in some of the bucket and, see like what is the closest comparable you can find in terms of the margins, in terms of the repeat purchase behavior, and then, try and ascribe a multiple to it. So I think that's typically the way we look at when we come across investments where where there haven't been any precedents to look at, that's how we do, try to find the closest proxy possible.
Yeah. So this brings back to our original question before we close the session, folks. Should I raise capital from outside at all? Should I raise debt, or should I just organically try and build a brand? One quick word answer from you all.
All depends on your ambition. All depends on that, and how much you're willing to tolerate outside involvement, stroke interference.
Straight shooter. Sunita?
Like you mentioned, we have this thing that the moment you raise, you're on a treadmill, right? You're going to keep running. You have to keep raising funds because everybody end of the day is still a financial investor. So unless you're actually thinking of building a much larger brand and, not happy with a lifestyle business, right? It's okay to have a lifestyle business and be happy with it, right? You're able to make money and make money for your employees, completely fine. But unless you want to actually build a much larger business where you know that you consistently are actually raising funds, don't look at raising funds at all. And it's completely okay, right? And there is no black mark for not raising funds there.
Awesome. Prayag?
Yeah, I mean, I think, you can bootstrap till the stage where you feel that, you don't, I mean, if at any stage you feel that more capital will help you scale faster or, get to your milestones quicker, that's probably the stage you should look at raising capital. You should not raise capital just for the sake of raising capital. So unless you need it, you shouldn't raise it. And you should raise how much you need, not more or not less.
Awesome. Fantastic. Thank you so much for your time, Chandu, Sunita, Prayag, and all the lovely audiences who've been posing questions and patiently listening. I loved it so much, and I'm sure everybody who was part of the session also took a lot of interesting points, a lot of takeaways, and lots to reflect and think about funding strategies. Thanks so much, guys. Thank you.
Thanks, Vidya.
Hope to have one more session soon. Yeah.
Sure. Thanks.
Have a nice weekend, folks. Bye-bye.
Yes.
Bye.
Bye. Tata.